What's up, everyone? It's Scotty with MoneyVest. So as November and December is upon us of 2023 and we are closing out the year, I wanted to run some seasonality analysis using S&P 500 data and also take a look at in the past 50, 60 years when the yield on the treasuries, the 10-year yield is above a certain level, how do the markets perform in November and December? That's what I really wanted to find out because in the past, we've kind of looked at that seasonality chart that shows us that, oh, Q4 is really good, right? November, December is the strongest months of the year seasonality-wise, but I wanted to specifically look at when the yields are higher, when the yields, the 10-year treasuries are higher at 2, 3, 4, 5, 6, 7%, is that still the case? Does that still hold true? Seasonality-wise, can the market still perform better in the last couple months of the year? So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available and will expire tonight. And the educational courses, fundamental analysis, technical analysis, options trading, and I'm working on a brand new psychology of investing and money course. That's going to be 50 to 60% off only for tonight for the Halloween sale that we have going on. So links are going to be down below, and that also does expire tonight after midnight. So love to have you on board. If you have any questions, just let me know. And if you also want to do like a 5 to 10 minute introductory Zoom call, also just let me know and we'll happy to schedule that for you as well. So first things first, let's just dive right into it. And first of all, I also want to mention that we've also got a brand new MoneyVest fair values. We are updating this to make it more useful. So what this is going to have is the price, the intrinsic value, and the difference, of course, how much the stock needs to go up or down in order for it to be trading at its intrinsic value based on my calculations and the risks associated with that company as well. And I'm also going to add a couple more columns here that are going to tell you the technical support and resistances. So very, very useful information. I've kind of removed a lot of the other stuff because I think it was not that relevant. You guys don't need to know the calculation if you want. We have individual detailed stock reports that you can access again on Publish on Web, where you can pretty much go and kind of take a look at the analysis overall, qualitative and quantitative analysis. But this right here, I think, is going to be very, very useful to give you a very quick glance overview and the price, percentage change, and of course the intrinsic value, some risks, some technical support, resistance levels. So that's also going to be available with the Patreon. With again, links going to be down below with that 16% annual discount. So let's just get started. This is the spreadsheet that me and my team have been working on. And what this basically shows us is going back since 1963, right? So we're going back, 40, another 20, 60 years, 60 years worth of data. This is, okay? And this is the yield, right? This is the starting yield, the 10-year yield on November 1st. And then this is the ending yield on that year, December 31st. This is the percentage change, whether we went higher or lower. And this is the S&P 500 value on November 1st, and then the closing value on December 31st to really understand, okay, what was that change in that 2-month period when the yields were indeed trading at highs of 2-4% levels. So if we basically come down, I'm just gonna, this is based on the yearlies. So 1963, 64, 65, 66, you're going all the way down. But you may not find all the years because not every single year the yield was above 2%. So the threshold for this analysis was when the yield crossed over 2%. If it was below 2%, so as for example, if you come down, you may find some years that have been skipped because the yield was not above 2%. So let me see if I can find one. There we go. So 2010, 2011, then you see a skip to 2013 all the way up down here. And that's because the yield was not over 2%, right? Over the last 20 years, more specifically, we've had interest rates that were low. And more specifically, we're hitting highs of over 16 years for the 10-year treasuries. And that's exactly why the analysis is going to have some skipped years. So for example, here you can see 2016 is also skipped because the yield was below 2% back then. So what we found was that the argument for the markets performing really good in November and December still holds true. So the bottom line is that when the yields actually do cross over 2%, the average gain and the median gain in November and December is a little bit over 2 to 3%, with a probability of 64% of the times markets being higher. Maximum gain of over 10.5%, and the most loss that we ever witnessed or drawdown in November through December was 9.4%, which if you come back over here, I may have highlighted that was probably around great inflation of 1973, 1974. Now, this was great inflation. I think today's circumstances kind of do replicate very well to the great inflation. So maybe that's something that we can, extrapolate a little bit of information. But then at the same time, 1970 and 71, we did see very, very nice rallies of over 10 to 10.35% in the month of November and December. So, and again, 1971 rates were lower. 1973, 74, we had yields almost as much as 7-8%. So that obviously did put a lot of pressure on the economy, and made credit conditions super tight. And as a result, we saw the markets, pretty much collapsing in November and December on the back of probably lower earnings at the time, because of higher interest rates. Now, this right here is 1987 and 1985. So you can see the yields were once again at over 9, almost 10%. And both years, we actually did see one of the years actually very strong rallies over 10%. And the following year, very, very small minimal loss of over 3.39%. So if you come back down, again, 64% probability overall when the yields are over 2%. If the yields cross over 4%, same exact thing, 63%, and this is also 63, 61.5. It's not until the yields start pushing over 8%, the treasuries over 8%, is when the probability of success starts to go down, and we come down from 60s to now 54, 55% of probability that November, December is going to be higher, and the average gain drops to 2.2%, and the median gain actually drops more dramatically to 0.77%. So that middle gain, 0.77, so less than 1%, as opposed to the median gains of a little bit over 3.5% in the previous studies. And the maximum gain is still at over 10.3%, but the lowest drawdown we see during that time, also surprisingly, only 3.39%. So we do see drawdowns, but not as severe during that time, and the probability of success also does come down a little bit. So seasonality-wise, November, December, as we are going into those 2 months starting tomorrow, and the yields are as high as they are, and we haven't quite seen the 10-year yields trade at these levels in 16 years. So, the last time we were above 3% was back in 2018, and the markets actually did sell off in 2018. So if you come back to 2018, this would have been highlighted over here. You can see 2018, the markets were down 8.5% because yields were over 3.14, 2.69%. Now, one more thing I want to mention is that one of the things that this study does not account for is the level of debt, right? The level of debt was actually way lower in 1970s and 60s and 80s, of course. 60 years ago, the debt was so low that even higher interest rates did not put a significant impact on the overall economy. But considering that the debt levels have increased to over 33 trillions, and we are once again running the deficit, even a 2 to 3% yield can impact the economy. Right? Of course, this analysis is based on the markets, because markets are very forward-looking. They're looking 12, 14, 16 months out. And what happens with the economy eventually will get priced into the market. But in my opinion, I think it is possible that higher interest rates, even at a 3 to 4% rate, that can start to play a bigger and bigger role as the economy takes on more and more debt, right? Because in the past, like I said, the debt levels were not as high. So even at a 7 to 10% rate, the government is not financing that at a significant amount, even if it's 7 to 10%. Right now, they're financing a very, very large chunk of their debt, even at 2 to 3%, 4 to 5%. That is enough to put a lot of pressure on the overall economy. So like I said, seasonality-wise, numbers look good. S&P 500, of course, is down a little bit over 10% from its recent highs, and a little bit over 14% from its all-time highs. You can see that we're down almost 14%. NASDAQ, of course, is in a little bit of a bear market, so you can see that we are down a little bit over 22% from its all-time highs, and from its recent highs, we are down in a correction over 12%. Now, NASDAQ and the S&P haven't really gone anywhere in the last 2 years and 3 years. If you take a look at the NASDAQ, we are pretty much at the same price as we were back in December of 2020. So it's been 3 years, almost 3 years. The NASDAQ is basically flat, right? So it's kind of interesting that we have seen it go up and then back down and then go up and then come back down, and pretty much has been trading in this range on a more broader pattern basis. So if I remove everything, all you'll notice is this range where this is a resistance, this is a support, and the NASDAQ has really just had this massive range of consolidation over the last 3 years. And that's partly, in my opinion, because of the yields, because they are definitely putting more and more pressure on equities and valuations and risk premiums. But until we start to see some rate decreases in 2024, I think it's going to be more and more challenging for the markets to push higher. However, looking at November and December only, so just looking at the next 2 months from a seasonality perspective, the probability for a gain is higher compared to a probability of a drawdown. And of course, seasonality is going to take into account, and this is after looking into the yields, and the treasury yields, despite pushing up to 4 or 5%, the markets are somewhat in a good position to see some gains in November and December, suggested by seasonality. So there is possibility for us to see a reasonable 6 to 7% gain. I wouldn't be surprised if you do continue to, maybe see a technical rebound, and again, continue to push higher to this lower high that's going to be sitting right over there, and break out over 13,200, some of those levels. S&P 500, same exact thing, where we are trading in this downtrending channel of lower highs and lower lows. We are oversold, so wouldn't be surprised to see it maybe get a little bit of a technical rebound back up to 43, 4,400. But we have to keep in mind that we are still very much in the context of these downtrends, and we're not out of the woods yet, considering that the markets are still pretty weak, and the rates are going to stay higher for longer. So hope you guys enjoyed this video, and let me know your thoughts down in the comment section below. Don't forget, we got lots of benefits, lots of discounts going on right now. Links are going to be down below if you're interested in joining us. As always, make sure that you drop a like, subscribe to the channel. Happy investing. I'll see you all in the next video.